Bespoke Investment Group co-founder Paul Hickey and HSBC Global Private Banking and Wealth America's CIO Jose Rasco. Great to have you both here. We have the S&P finishing down more than 1% and the NASDAQ down more than 1% as well. The Dow basically right around the 1% mark. It's great to have you both here. Paul, I'm going to start with you because, yes, we've got light liquidity, thin volumes. We don't have that manifestation of the Santa Claus rally. Mike Santoli was just talking about it at the end of the last hour, the fact that we saw a similar dynamic last year. We're still poised to finish up 24% on the S&P. What does history tell us about this moment in time?
Yeah, so I think as far as the December weakness is concerned, I wouldn't put a lot of weight into that. More recently, actually, the positive seasonalities of December haven't really been nearly as strong. Also, what's interesting to note is that this will be the fifth time that the S&P 500 was up 20% or more in an election year. And in 4 of those Decembers, the S&P has been down. And it sort of makes sense if you think about it. You go into the end of the year with the market up a lot. You're coming in with a new administration. So the uncertainty is going to be there. And you can't fault investors for ringing the register a little bit here. So I think in that respect, I wouldn't put too much weight into it. And as you said, we're going to be up 25% about this year, which is the same as last year. And what's really interesting, at this point in the year last year, it's nearly the exact same percentage gain in the cap-weighted S&P 500. And then if you look at the equal weight S&P 500, it's, again, nearly the exact gains. They've underperformed by a lot with gains of about 12% this year. So in that respect, we've seen the same play this year as last year, but under much different economic backdrop. So, you would think, okay, the Fed policy has been much different in both those 2 years. The path of interest rates has been different. Commodities have been different, and the dollar has been different. But overall, we think you have to look into the broader perspective, not just a few macro indicators. And what we see for the year ahead is a positive backdrop, which is keeping us invested, but recognizing the fact that we've seen big gains for the last 2 years. So it's going to be harder to see the gains going ahead. But the burden of proof is still on the bears going forward.
Okay. Jose, how do you see 2025 shaping up? Is third time a charm? And I ask that knowing that we've seen a backup in Treasury yields in the last couple of weeks, and there is more, or at least investors are digesting the possibility of more monetary and fiscal policy uncertainty in 2025.
Well, first of all, happy holidays, guys. And secondly, I would say, unquestionably, we're going to see some volatility. Remember, we have a new administration, new fiscal policy, uncertainty there, as you mentioned. But keep in mind, what did the Fed say to us in mid-December? They said, if inflation stays flat next year, or if it goes up, which is what they're predicting at the core level, then we're only going to ease twice, right? And we still think that we could see a positive surprise there on the inflation front. We have the secular tech disinflation, which will continue, or deflation. We have disinflation from imported goods. We have a strong dollar, which helps that as well. So I think we have some good signposts up ahead. And remember, we're looking for slower economic growth next year. So slower economic growth in real terms, usually that means slower inflation at some point. And last but not least, it's important to remember the S&P 500, the NASDAQ, these are slivers of what the economy is really doing. And if you look at revenue expectations for next year, they are up for the S&P. So that's telling us that component of the U.S. economy looks pretty healthy. And to Paul's point, I think we see the growth value disparity remains a problem. And remember, in March, we have the government has to come to a conclusion in terms of the debt ceiling and the reconciliation process. And we have earnings coming out at the beginning of January. So a lot of uncertainty. I would look for a lot of volatility. It's a stock picker's market in that regard. But we think that growth value disparity is going to help lead to more of those relative value trades, something we saw in the summer, which led to some volatility.